Welcome back. So this was a special weekend because Berkshire Hathaway released their 2022 annual report. And y'all know what came with that was the letter to the shareholders from Warren Buffett. So I'm very interested in Berkshire Hathaway because while I only own one share so that I can go to the meeting this year, it's actually her largest position in her custodial account. So what I wanted to do was run through the letter to the shareholders, show you some of my highlights, and then show you how I calculate fair value for Berkshire Hathaway and show you why I think it's actually still undervalued right now. So the letter to the shareholders is actually the second thing that appears on the annual report. The first thing is Buffett's or Berkshire's performance against the S&P since 1965, and you can see they've gotten a 20% compounded gain versus the 10% for the S&P, which really adds up over time. Look at that, 3.8 million% versus 25,000%, okay? Pretty crazy. All right, so for the letter, I'm just going to jump right to my highlights, okay? I'm not going to go through each section. The first thing that I thought was really neat was this idea about how mediocre a lot of his bets have been. So let me find that. All right, yeah, it's right here. He says, look, our results have been the product of only about a dozen truly good decisions. That's only one every 5 years, okay? That's pretty crazy. Above that, he said that even some of his bad decisions just got rescued by good luck, like Solomon and US Air. Okay, and then he gives some examples of that, and the two examples are Coca-Cola and American Express. Both of those, he spent about $1.3 billion on Coke, and then $1.3 billion on American Express. And they each grew to over $20 billion, okay? So that's $25 billion for Coke and $22 billion for American Express. So it just goes to show that, like, you know, a few really good bets can just carry you for a long time. You don't need to be right about every decision, as long as you're right about a few and you stick with those few, right? Next thing is going to be his note about the operating income. And you can see here he says the company's operating earnings had the best year ever, 30.8 billion. So let's just say 31 billion. And then he says this key phrase, which, you know, I don't think anybody should miss. Charlie and I focus on this operational figure and urge you to do so as well. All right, so that should be, you know, sending off alarms in your head. This is very important, okay, at least to them for calculating intrinsic value of Berkshire. And what he does is he gives the example of this operating earnings versus what their GAAP required to report. And the reason the GAAP stuff is so messed up is because they're actually required to disclose the unrealized gains or the change in their portfolio of investments every quarter. And this table kind of illustrates it, but let me show you it better on a graph. So this is actually Berkshire Hathaway's net income going back to 2003 every quarter, okay? And this is where that accounting change took place, right here around 2017. And look what it did to their net income, okay? It was smooth, but then, you know, you got all this craziness. So that's why you should really not pay attention to that, okay? All right, let's go back to the letter. The next thing is going to be the repurchases and the shots that he kind of fired at Biden, I would say, or just anybody who's pushing back against companies doing share repurchases. Charlie Munger kind of fired against that as well in the Daily Journal interview, if you watch that. Okay, so he says this year they repurchased, 1.2% of the company's outstanding shares. They also were advantaged at Apple and American Express, where, those two companies repurchased shares as well. Okay, so, and he says the obvious, look, the math isn't complicated. When share count goes down, your interest goes up. Okay, every small bit helps as long as it's made at a price that's below intrinsic value. Now, this is the quote that I love because it really is kind of firing against what Joe Biden said in the State of the Union, right? When you're told that all repurchases are harmful to the shareholders or to the country or particularly beneficial to CEOs, you're listening to either an economic illiterate or a silver-tongued demagogue. Whew, okay. Anyway, we know how he feels about the proposal to increase the tax on share repurchases by to quadruple it, go from 1% to 4%. Okay, now I want to go to something else that he said, and that is about the United States and their position, their ownership of U.S. companies, okay? So basically, he says, they own 8 of these giants in the S&P, and then they own other companies that would be in the S&P 500 if they were publicly traded. Okay, and then this is the key phrase, I think. Our 10 controlled and non-controlled behemoths leave Berkshire more broadly aligned with the company's economic future than any other U.S. company. Okay, so if your bet is a bet on the United States, then this is the best place to keep your money, right? They are aligned. You always got to trust the alignment, right? That's an inside joke for anybody who gets it, okay? Moving to this interesting note about taxes. I just thought this was neat, right? During the decade ending in 2021, which was 2011 to 2021, the Treasury received $32 trillion and spent $44 trillion. All right, so like I've said before, I did not go to business school, but I did learn in chemical engineering that it's not a good idea whenever you start taking out more than you're putting in, right? That's like Chemie 101, right? Mass balance, okay. Anyway, and he kind of talked about that. He says he still said, while this is, alarming, they believe that near-term economic and market forecasts are worse than useless. So he kind of throws this out there and then says, but you know what, still ignore that because nobody really knows what's going to happen short-term. And I do agree with that too. All right, and then the last piece before I go to valuing Berkshire is his notes about Charlie. And I just think you should just go read all these on your own. So he says, Charlie and I think pretty much alike, but what it takes me a page to explain, he sums up in a sentence. I think Nietzsche said that about himself, right? That he could write in a sentence what other people took a book. But so I think that's a big compliment Warren gave to Charlie. But here's some of his thoughts. Look, I would spend time and read these because they're all quote worthy. And the reason I don't have a quote at the top of my video this time is because there's so many within the video that I think could have made it. I couldn't narrow it down to one. All right, so that's that. I urge you to read this on your own. I think it's great. And then there's a book. It's called The Essays of Warren Buffett. Somebody took all of his shareholder letters and kind of grouped them into different categories and then put those for each chapter to where it's like a really easy read and you can kind of jump to whatever section you're interested in. I think that's a great book, okay? Now let's go to how am I going to do fair value, okay? Well, I've thought about this a lot, and I think that there is a very simple way to do that, okay? And the answer lies kind of in how Berkshire divvies up their balance sheet. So let me jump to their balance sheet. Okay, so this is their balance sheet ending December 2022, and what's interesting is that they divvied up between insurance and other, and then railroads, utilities, and energy, okay? So another way to think about it, and it's probably not super accurate, but we're going to keep it simple, is that this is like their investing side and then this is their operating side, right? So what I want to do is take those two pieces and put them together, all right? So the first one is going to be the operating side, and they told you that their operating income was $30.8 billion. So how am I going to use that to get some kind of fair value for the operating section? I'm going to do something really complicated and take the 30.8 and multiply by 10. Okay. So look, the reason I did that, you can argue it should be higher because they're growing and you want to factor in the growth rate. You could argue that it should be lower because this is operating income. It's not taking into account their other expenses and taxes and stuff. But you know what? Since we're in a base 10 civilization and I'm feeling lazy, we're doing 10. Okay, so operating section worth about $308 billion. And then for the insurance and other section, what I'm going to do is literally just take the equity in there. So they break down the assets into these two categories. They also break down the equity as well. So you can see their total, not equity, they also break down the liabilities as well. So their total liabilities in the insurance and other section is going to be 291, and then their total assets was 726. So what I'm going to do is take this 308 number and add 726 and minus, I already forgot the number. Let's see, what was it? 291, that's right. Okay, minus 291. And what I get is that the current value of the business should be about $743 billion. Okay, so that was super crude, super rough estimate, but I actually think it's pretty close. That means that they're trading at, what is this, 671 divided by this, 671 divided by 743, trading at about 90% of this value. Like I said, I think this is pretty conservative. I think they're actually higher value than this. I think it's probably, trading at about 80% intrinsic value right now. Probably operating income a little bit higher ratio, and then the equity one, I think that you could put a higher multiple on that if you think he's going to beat expectations with the investing side, but I'm happy with what we did. So what does that mean for the share price? I'm just going to do this ratio reverse, so raise it to the -1, and then multiply by the current B share price. And I think right now they're probably worth $330, $340 a share conservatively. It's probably higher than that, like I said. And really, just going back to the very beginning of the video, I think that this is still a great place to put your money if you're betting on the future of America. If you just want to put your money somewhere and let it sit for 18 years until somebody else gets control of it, let's say, like a custodial account. But anyway, that's just my take on it. I hope you learned something. I hope you enjoyed the video. Like, subscribe. I'll see you next time.